Today, we're diving deep into a really fascinating real-world case study. It's all about navigating, the often turbulent waters of financial markets. We're talking about debt optimization, managing expiring rate caps, and specifically how one smart, proactive move saved a company a significant amount of money.
Yeah, nearly $300,000, wasn't it?
Exactly. Nearly 300K.
Yeah.
And look, this isn't just about finance in a vacuum. It's really about strategic decision-making when you're facing uncertainty.
A situation every executive knows well.
Absolutely.
And what's fascinating here, I think, is how understanding market expectations and, crucially, where they might diverge from reality can lead to such tangible benefits. This deep dive, it's going to show you a really concrete example of a proactive strategy in action.
Yeah.
And why it mattered so much for the specific owner-operator.
So our mission today really is to pull out the critical nuggets of knowledge from this case. The decisions, the market insights, the direct financial impact. We want you to walk away with lessons you can apply to your own strategic thinking, maybe your own portfolio management.
Right, understanding how these pieces fit together.
Okay, so picture this.
Okay.
It's August 2024.
Right.
The clock is ticking down to February 15th, 2025. And our protagonist, a seasoned mid-market owner-operator, is facing a pretty critical decision. They own a well-performing 120-unit multifamily property. It's seen consistent moderate growth in its net operating income, the NOI.
Yeah, steady performer over the 5 years they've held it.
Exactly. But the core issue here is their $48 million loan. That's a big piece of their capital structure.
Too significant.
This loan has a rate cap. It's at 2.46%, but it's set to expire on that February 15, 2025 date.
Deadline.
The deadline. So understanding the stakes, they, very wisely, brought in their advisors back in early August 2024.
Smart move. Get ahead of it.
To figure out their next strategic move.
That's right. The owner knew this cap was, well, a ticking clock. The immediate challenge was understanding the potential costs, the implications of getting a new one.
What's it going to cost me?
Exactly. Their primary concern, and this resonates with any executive at a big financial turning point, was just getting absolute clarity on future obligations.
Certainty, yeah.
So the analytical team, they had two really clear interlinked objectives. First, meticulously compare the cost difference between what's called a spot starting rate cap versus a forward starting one.
Okay.
And second, maybe even more importantly, pinpoint the absolute optimal timing for execution and then, guide the client through that critical window.
Okay, maybe we should clarify those terms. Spot versus forward start.
Yeah.
Because that difference is, well, it's key to this whole thing.
Yeah, good idea. So a spot starting cap, it's pretty much what it sounds like.
You buy it on the day it needs to start.
Exactly. February 15th in this case. You wait until that day, you buy it, it starts then. Simple enough.
Right.
But the forward starting one, that's fundamentally different.
You buy it before.
Yeah, you purchase it before its effective date, maybe months in advance like they did here.
Okay.
But it still only kicks in on that original future effective date, February 15th.
Ah, got it. So it's
Right.
about timing the purchase, locking it in early.
Precisely. And that strategic choice act now for later or wait until the 11th hour, that's really what this whole deep dive hinges upon.
Makes sense.
Exactly. And, before any complex numbers were even crunched, the very first step, and arguably the most important one,
Was what?
was a really comprehensive exploration into the client's own strategy, their market outlook for the asset.
So talking to the client first.
Absolutely. They held preliminary calls, not just to grab data, but to deeply understand the sponsor's long-term goals for this specific property. This wasn't just, ticking a financial box. It was about making sure the financial strategy aligned perfectly with their overall business plan, their investment horizon.
And what was their plan?
In this specific case, the borrower was very clear. They intended to hold on to the property for the long term.
Okay. Not looking to sell soon.
No. And a full refinance, well, it just wasn't financially sensible at that moment. Market conditions weren't right.
Right.
Which meant rolling the cap forward was really the only viable, responsible path for, prudent debt management.
Got it.
And that foundational understanding, their intent, their market view, that's absolutely critical for any executive making these kinds of strategic financial decisions, whether it's for a balance sheet, a major project, or like here, a property.
Okay, so this is where the market insight really starts to play a big role and where the strategy started to maybe differ from what everyone else was thinking.
Exactly.
So back in early August 2024, when the advisors ran their first analysis, the 1 month was trading at 5.35%. Pretty high.
Robust, yeah.
Now, here's the kicker, and this is what gets really interesting. The market, as reflected in the forward rates table,
Which is basically the market's best guess of future rates.
yeah, it was predicting a hefty 1.46% of rate cuts by that critical February 15th, 2025 date.
Wow, that's a lot of cuts expected in just 6 months.
It's a significant anticipated shift.
Right.
And it created this 42 basis point delta that's 0.42% between the two curve dates.
Right.
So in essence, the market was shouting, expect much lower rates soon.
And this is precisely the point where critical thinking about market expectations becomes so important for decision makers.
Okay.
After discussing these, frankly, pretty aggressive projections with the borrower, they both sort of agreed.
It seemed unlikely.
Yeah, it seemed highly improbable the Federal Reserve would actually cut rates that aggressively, as much as the market was forecasting.
Right, because the forward curve, these models, they're the market's guess, but they can be wrong.
They often diverge, yeah. Especially when sentiment gets, overly optimistic or pessimistic. The team recognized that taking advantage of this specific mispricing.
Where market hopes seemed a bit detached from their own view of economic reality.
Exactly. Taking advantage of that presented a unique, compelling opportunity. And crucially, with very little discernible downside risk for the client, they were essentially making a calculated bet against the crowd.
I'm curious, though, what gives a team the confidence to basically bet against the forward curve? I mean, that curve represents the market's collective wisdom, right? Is there a specific analytical framework behind that conviction? Or is it more about like a gut feeling about the Fed in the economy?
That's an excellent question. And it's really less about gut feeling and much more about a robust analytical framework combined with historical perspective.
Okay.
Look, the market forward curve is a powerful tool, sure, but it reflects sentiment and expectations.
Which can be swayed by headlines, maybe.
Absolutely. Short-term news cycles, even herd mentality. Our analysis, though, it focused on the underlying fundamental economic data. We looked at the Fed's stated dual mandate, maximum employment, price stability, and their historical reaction functions, how they've behaved in the past.
So less about what the market hopes for, more about what the Fed says and does.
Precisely. We track what the Fed says they'll do. We analyze inflation trends, employment, growth against the Fed's own targets. So when the market's curve was projecting these really aggressive cuts...
You looked at the actual data?
Yeah, we looked at the, sticky inflation data at the time, the pretty robust labor market, and our models just suggested a far more measured approach from the Fed. Much slower cuts, if any.
Okay.
And that divergence, that gap between market pricing and economic fundamentals, that was the critical signal.
Opportunity.
The opportunity. It let us see that buying a forward cap back in August would capitalize on the market's overly optimistic view of future rate cuts.
It's fascinating, really fascinating how that deep understanding of market mechanics, plus a willingness to challenge the prevailing sentiment, can lead to such a crucial decision. The team understood that rate cap pricing is super sensitive, right, to the strike rates, the term length, market volatility.
All those factors, yeah.
By choosing that forward starting cap back in August, they essentially took a huge chunk of potential future risk off the table.
Right. And eased that future term pressure.
Think about it. If they had waited until February 2025, the Fed would have needed to cut rates even more dramatically than those already aggressive August predictions.
Which seemed unlikely.
Exactly. For that spot cap to have ended up being any cheaper, they'd been betting on an unlikely scenario playing out just to maybe save a bit versus locking in a known cost.
And that's precisely why it became, almost a no-brainer for this client from a risk-reward perspective.
Okay.
Another critical element was the market environment at that specific time. They were operating in what's called a steeply inverted yield curve environment.
Okay, break that down for us. Inverted yield curve.
Sure. It's essentially when short-term interest rates are higher than long-term rates.
It's just kind of backwards usually.
Usually, yeah. It often signals that investors expect an economic slowdown in the future, and therefore they expect lower rates down the line. It's a fairly rare occurrence, and when it's steeply inverted, it suggests a really strong expectation of future rate decreases.
So how did that help this client?
Well, for them, it meant that buying a forward starting cap, one that kicks in several months later, was significantly cheaper than buying a spot cap right then and there.
Why cheaper?
Precisely because the market was pricing in those dramatic future rate cuts implied by the inverted curve.
I see.
They were able to capitalize on that market expectation of future weakness even if they didn't fully buy into the extent of those expected cuts. They used the market's pessimism to their advantage.
Okay, so given all this meticulous analysis, the differing market views, the client strategy, the bet against the crowd, using the inverted curve, what was the ultimate payoff? Let's unpack the numbers, because this is where that nearly $300,000 saving really comes into focus.
Right. So let's fast forward. It's February 14th, 2025, literally the day before the original cap was set to expire.
Crunch time.
Crunch time. And the reality, it was starkly, almost dramatically different from the market's August projections.
How different?
The Federal Reserve, true to our team's analysis, had only cut rates by about 1%. Not the massive cuts the market had predicted 6 months prior.
Wow, only 1% versus the 1.46% expected just by February.
Exactly.
Yeah.
Far less aggressive. In fact, real-time rates were actually higher than what the market had projected them to be way back in August.
So the market got it pretty wrong.
Quite wrong. And this massive shift, this recalibration of Fed policy expectations was the single biggest driver of the cost difference in the caps.
Right.
By having the foresight, the proactivity to lock in their cap in advance.
Back in August.
Back in August, specifically in that deeply inverted yield curve environment, they secured tremendous savings. It just demonstrates the immense power of acting on insights rather than merely reacting to deadlines.
Okay, so let's look at the cold, hard numbers. What would it have cost if they waited?
Right. When the team ran the calculations on February 14th, 2025, for what a spot starting rate cap would cost right then and there, it came in at a staggering $846,000.
Ouch. $846K. And what did they actually pay for the forward starting one back in August?
That one, the one they executed, it cost them $547,000.
Okay, so the math is simple then.
Very straightforward. That's a direct, undeniable saving of $299,000.
Almost $300,000 on the nose.
Pretty much. Essentially, if the borrower had just waited, or reacted to the deadline rather than proactively anticipating the market, they would have just forfeited that nearly $300,000.
Wow.
And the core reason for that huge difference, like we said, goes back to those wildly misaligned market expectations.
The inverted curve in August helped them lock in a lower price.
Exactly. The steeply inverted curve made that forward cap cheaper then. Plus, remember, back in August 24, the market was aggressively expecting 9 full rate cuts by the end of 2025.
9 cuts.
9! By February 25, that expectation had plummeted to just 3 cuts.
Huge change in sentiment.
Massive. And that dramatic recalibration in Fed policy expectations was the major driver of that cost difference hitting the cap pricing directly.
So the savings are undeniable, almost $350,000.
Yeah.
But let me play devil's advocate for a second.
Go ahead.
What if the market had been right? What if the Fed had slashed rates like crazy? Was there a big risk profile they took on? Or was it really a low downside move?
That's a fair question. But in this specific scenario, the downside was remarkably contained.
How so?
Well, if the Fed had cut rates super aggressively, as the market projected, the forward cap they bought wouldn't necessarily have cost them more money out of pocket.
Yeah.
It just might not have yielded such dramatic savings compared to waiting. The price was locked in.
Right.
See, rate cap pricing is dynamic. It's influenced by the rate level, yes, but also by implied volatility, the market's expectation of future swings. By locking in early, they effectively hedged against upward moves in cap premiums, which could be caused by higher than expected rates, which is exactly what happened.
So they protected themselves from the actual outcome.
Precisely. The risk, if you can call it that, was that they might have paid a slightly higher premium back in August for peace of mind if rates had absolutely plummeted.
That sort of opportunity cost, maybe.
Potential small opportunity cost, yeah. But given their long-term hold strategy and the overall market outlook, the strategic benefit of securing a known manageable cost far outweighed that minimal theoretical missed saving.
Right.
It was a classic case of mitigating the known larger risk, the risk of rates not falling as much as hoped, which would make waiting much more expensive.
Makes perfect sense. And beyond the raw financial savings, which are obviously substantial, this proactive move brought other benefits too, right? Things any executive managing big assets would value. First, yes, the $299,000. Huge. But second, it sounded like it massively reduced their stress levels, eliminated that term pressure.
Definitely. That pressure around expiring hedges is immense. By executing that forward starting cap early, they essentially took a massive amount of market risk off the table.
Peace of mind.
Tangible peace of mind. They didn't have to worry about volatile market swings in those months leading up to expiry. They were hedged, regardless of where the market went.
Which is why being proactive is so key. I've seen it too. Clients caught flat-footed, scrambling at the last minute.
And having to accept whatever the market dictates, often much worse terms.
Exactly.
And the third major benefit, which is often overlooked, but honestly incredibly valuable,
What's that?
enhanced financial stability and clarity for their strategic planning.
Predictability.
Yes. With this proactive move, the borrower gained a much clearer, more informed picture of their expected future costs. That stability lets them better project things like coverage ratios, overall financial performance.
Which is crucial for planning.
Absolutely essential for long-term strategic planning, for capital allocation decisions, maybe even for future equity raises, especially with a large asset like this.
Yep.
And look, this principle, anticipating market shifts, it isn't just for rate caps or commercial real estate.
Right.
No, we see similar strategic advantages in, say, currency hedging for businesses with international operations, or even managing commodity price exposure for manufacturers. The common thread is always leveraging foresight to mitigate future risk and secure better terms, rather than just reacting when the deadline hits.
And this isn't just a one-off move for them, right? They continue to monitor things.
That's right. It's an ongoing process. Their advisors use proprietary debt management solutions, constantly analyzing key performance indicators, KPIs, to keep the client ahead of the curve.
Could you maybe quickly break down some of those KPIs? Why are they so vital?
Absolutely. So beyond that initial strategic move, continuous monitoring is key. They look closely at DSCR.
Debt service coverage ratio.
Right. Shows how well the property's income covers its loan payments. You want that strong. Then there's debt yield.
Okay.
Measures the property's income relative to the loan amount. Crucial for assessing risk from a lender's view.
Got it.
We also analyze the weighted average coupon. The average interest rate across all their debt helps understand the overall cost of capital. And finally, weighted average months to maturity. Basically, how much time is left until their loans mature. Directly informs future refinancing or hedging needs.
So tracking all that helps them stay proactive.
Exactly. By constantly tracking these, they can identify and prioritize actions that improve cash flow, optimize the debt strategy, maximize returns, always aligning with the client's risk tolerance and goals. It's a continuous dynamic process.
So let's bring it back. What does this all mean for you, the listener? Whether you're managing a portfolio, leading a division, making those key executive decisions. The core message from this deep dive seems pretty clear. Proactivity in financial management, it isn't just a buzzword.
Not at all.
It's a direct path to real, tangible savings and enhanced stability, even when market cycles get challenging. That mid-market owner-operator, they didn't just get lucky.
Yeah.
They made an informed, strategic decision. It was based on a deep understanding of market dynamics, plus expert analysis.
And if we connect this to the bigger picture, this case really highlights how crucial it is to constantly evaluate your financial positions. Don't just react to deadlines, opportunities, like the ones presented by that inverted yield curve or those misaligned market expectations. They're always there.
If you look for them.
If you're prepared to look for them and act decisively, yes. Whether it's for rate caps, swaps, other hedges, or like I said, even managing supply chain contracts, pricing strategies, maybe investing in new tech. The principle applies broadly,
Right.
which I think raises a really important question.
Which is, how can you apply this same forward-looking, proactive mindset? How can you apply it to your own financial strategy or really to any area of your business? Anywhere where anticipating market shifts and taking calculated risks could lead to significant advantages.
Yeah. What opportunities might you be missing right now?
By waiting instead of acting strategically in advance. Or maybe just by accepting the prevailing market sentiment without that deeper critical analysis.
Good questions.
That's definitely something worth mulling over. We hope this deep dive has given you a fresh perspective on effective debt management and really the undeniable power of proactive, informed decision-making.
Hope it was useful.
Until next time, keep digging for those insights.